So here I am, and it's great to be back, to say the very least. There is a lot to talk about and not a lot to talk about. Now, I know this sounds odd, but it's interesting. For all of you who were here, of course, last year, I have a reasonably benign view on the direction of the U.S. economy, and of course, that's true here in the state, in the state as well. But of course, not too long after I left here, what ended up happening? We had a 20% sell-off in the stock market. Started early December, went really through January or February. And with that decline in the stock market, hibernation ended. And all the bears started rolling out of their cave. And we have been lambasted on a day-to-day basis with negative headlines. The recession is coming. Right? How often have you read articles about this? Month after month, week after week, day after day. We have been bombarded with negative headlines. And it's funny because at the start of the year, the headlines out of the press were like, is this it? Are we going to have a recession? Is this expansion going to come to an end? But by the summer, they had convinced themselves. No longer was it, are we going to have a recession? It's what is the recession that we know is going to happen? What does it mean? What does it mean for the election? What does it mean for millennials? What does it mean for real estate? What does it mean? And of course, my favorite part is when you turn on one of these 24-hour news networks and you see the folks at CNBC, and they talk to each other and they say, well, why do you think we're going to have a recession? Well, when everybody starts talking about a recession, that can cause a recession. It's quite a power you have there, Spider-Man. You might want to, use that responsibly, as they say. And it goes on and on and on and on and on. And in the midst of all this chaos, something else happened. This became the longest expansion in U.S. economic history. Now, mind you, this isn't the first time in the last 8 or 9 years I've stood in front of you and talked about the bearishness of the national conversation. Indeed, this seems to be kind of par for the course for this entire expansion. Every time you turn around, someone wants to talk about how things are not good. Now, to start this conversation tonight, I do want to talk a little bit about when I was bearish. Because, you go back to 2006. I'm not a permabull. I'm not the guy who always says everything's great, everything's fine, everything's going to be wonderful. This expansion is going to go on forever, and your home's going to be worth $10 billion in 2 weeks. Back in 2006, when I left UCLA and I was working for myself for the first time, I stood up in August 1st of 2006, I still remember this, and I told an audience of people, real estate's going to crash, and it's going to yank the U.S. and probably the global economy down with it. So it's a little bit of a contrast with the messages I've been giving over the last couple of years, but I think it's worth talking about why. See, one of the big misunderstandings about recessions is that they just sort of happen now and then. A lot of folks talk about this next recession largely because of the fact that, this is the longest expansion ever. Ergo, it has to come to an end. After all, it is a business cycle. But you see, the term business cycle is confusing. Because when we use the term cycle from a macroeconomic perspective, we're not saying, every once in a while you have a recession. What we're saying is when a recession does hit, it goes through very distinct phases. It's a cycle that the economy goes through. But just because what happens in a recession has a cycle to it doesn't mean the recessions themselves are cyclical. Recessions are actually anomalies. The default mode of any economy is growth. Because economies are made up of people who are trying to get ahead in life, who are trying to do better for themselves, trying to do better for their families, trying to get ahead in life. And collectively, that leads to an economy that grows. But once in a while, that system gets disrupted. And that disruption has to occur for a reason. It has to be caused by some large negative shock hitting the system. Now, talking about recessions is really talking about what that shock is going to be. Back in 2006, to me, it was obvious. Because what I was looking at in 2006 is an economy that was healthy on the surface, but when you dug away, when you got into the meat, when you looked at the fundamentals, things were out of control. There was a massive flow of credit moving into the households. Credit that seemed to have no constraints. It was completely divorced from anything we call credit. And the net result of that, of course, was that we saw a number of disturbing real-world trends. One of those problems, of course, was with housing. Now, housing, of course, was reflected both in terms of the increase in prices, but also in terms of the excessive production of housing. And the other side of it, probably more dangerous, was the fact that people took all this housing wealth and unlimited flow of credit to heart, and basically, they started overspending. We saw a dangerous diminishment in savings rates. In clear, the U.S. economy was not in any stable place, and it was really only a function of time before things started to unwind, thus creating that negative shock that created the recession. Now, that recession did occur in, of course, December of 2007. That's the official beginning of the recession, and it went on for about a year and a half, and it was a nasty one, to say the very least. Now, I want to distinguish the causes of the recession from what economists like to call leading indicators. Because we all look to different parts of the economy for an indication that there is a recession about to hit. And the reason for that, of course, is a lot of times it's even controversial to suggest there is a recession going on. For the first 6 or 7 or 8 months of 2008, I was still debating people on whether or not we were having a recession when we were already in it. So a leading indicator is something that should indicate that indeed we are about to go into a recession. Now, what is a leading indicator? That in itself is controversial. What set off this current wave of negativism in the economy, of course, was predicated on the basis of that big stock market sell-off. Because we are told all the time that the stock market knows all, sees all hail the mighty stock market. It is a leading indicator. Or is it? Let's think back to that Great Recession. When did the stock market wake up to the fact that we had a problem? When was the big stock market sell-off? Does anyone remember?
September 2008.
You got it exactly right. You need another $100 gift certificate, whoever said that right there, boy. September of 2008, exactly right. Far from being a leading indicator, Wall Street seemingly was the last person in the room to figure out we had a problem on our hands, Houston, okay? So spare me the idea that the stock market tells you anything about where the economy is going. So I come to today and I say, why? Why do you think we're going to have a recession? I look at the economy today, for all the hubbub, for all the negative headlines, candidly, we're still in this same old Goldilocks economy. Not too hot, not too cold. GDP growth, nice and steady. Labor markets, consumer spending, business investment, wages, exports, energy, home production, level levels, everything's safe, sustainable paths. To be honest with you, I'm not even sure I changed these bullets from last year, okay? I really don't. The question marks are because they keep using a damn PC instead of a Mac. Interest rates are low again. Inflation's constrained. Housing markets are starting to balance. Remember the housing market meltdown we were all supposed to have? Chance of recession next 2 years? Same answer I've given you for the last 9. Ain't gonna happen. I know. You got the Wall Street Journal economists saying it is. You got the NABE guys saying it is. Forget all. Again, these recession surveys, they're not leading indicators. Every single recession survey in the last 8 years told us the next recession's 2 years away. Right? Every single one, year after year after year. Forget about that stuff. Remember, it's not the when, it's the why that matters. Now, I get it. There's issues out there. Labor shortages, housing shortages. We have the stock market volatility. We went from that 20% sell-off to now a record high. Hints of aggressive risk-taking, an overly aggressive Fed, the inverted yield curve, sharp growth in government deficits, and let's not forget the trade war with China. None of this will cause a recession, at least not now, not in the current form. It just won't. None of these things rise to that level. To me, it's still politics. That is the biggest issue. Because if you listen to the rhetoric coming out of D.C. or indeed Sacramento, you would swear to God that we are going to hell on the express lane. Everything's falling apart. The world is nothing but chaos. And why? Well, it's the other party's fault. We all know that, right? I mean, that's what it's devolved into. Everything's a problem, and it's their fault. That's not how you run a country, people. And, of course, while they're doing that, running around their hair on fire, they're ignoring the true long-run issues, whether it's entitlement reform or issues with public infrastructure, growing wealth inequality, so on and so on and so forth. We're not having the right conversations about the right things. It's completely disconnected. And it's not getting any better. You know, we had that big election just a few weeks after I was here last year. And you know, the Democrats took over Congress. Some people cheered, some people were upset. Here's what I know. There are fewer centrists in Congress and the Senate today than there were a year ago. And that's what scares me to death. I don't care what party you're in. I just want you to have a grasp of reality. And there are fewer and fewer people in either party who can make that particular claim. So let's get right into it, GDP. You know, we had some revisions in the GDP data, and it was more boring than you even thought. For all the chaos in the headlines, what do we have? 2.8% growth in 2017, 2.5% growth in 2018, 2.55% growth in the first half of this year. This is just nice, steady growth. Consumers add, a little less than 2% to growth on a year basis. Business investment was really strong, slowed down a lot this year, but government spending's picked up the slack. Trade's been on net, basically flat. And of course, if you didn't catch the news, we got our GDP numbers this morning. What did it come in at? 1.9%, which, by the way, is exactly the same number as the last 2.5 years. Because these numbers aren't measured with a lot of accuracy. We do the best we can, but there's still surveys. There's still noise. This number we have right now doesn't even have a complete set of data. It's going to be revised twice more in the next 2 months, revised again next year, and revised again in 3 years. 1.9%, that's exactly the same as every other number. But don't let that confuse anybody. U.S. economy strained in the third quarter. Strained? Give me a break, people. There's no strain. It's the same old number. Nothing has changed. Consumers, 2/3 of the economy. Consumers healthy, they'll push us through a lot of problems. Unhealthy, they make any problem 5 times worse. Whereas the consumer, they look amazing. You know, right now, consumer spending growing about 2.6%. Savings rates are back up above 8%. You know, except for that little weird change in taxes back in 2011, the last time savings rates were that high was back in 1992. This is a great number. Consumers look healthy. Debt levels, incredible increase in debt-to-income ratios. That huge deleveraging, very painful decline afterwards. That's the Great Recession and its aftermath. Since 2011, consumer debt's been growing a little slower than incomes. Right now, debt levels are actually lower than they were back in 2002. These are great numbers. I mean, again, slow across the board. Everything's nice and steady. What are people spending money on? Well, if you listen to the news, people are desperately spending money on basic essentials. Food, shelter, Really? Look at the numbers. This is 3-year growth rates in consumer spending. Foreign travel, 29%. Top of the list, people. I'm pretty sure that's Trump right there, boy. I know you're out there. Restaurants, number 2. Recreation, number 3. Then you get into housing and furnitures and stuff like that. People are having fun. They're eating out. They're traveling. They're going to music concerts. I mean, come on. Give me a break. Yeah, financial obligations ratio because of the lack of debt buildup with low interest rates, the lowest it's ever been. Give me a break. People look great. Home sales. Remember the big housing meltdown we all had to listen to? God, everybody in California said, this is great. I'm going to sit back and wait for a 20% price decline on that house I had my eye on. Oh, give me a break, people. Why? Because home sales slipped from 5.5 million down to 5 million seasonally adjusted annualized basis. Ooh la la, so what, people? This is a housing meltdown, going from 7 million to 3.7 million. That's a housing meltdown, okay? This is just noise. And since then, it's bounced back. Last couple months, 5.5 million units. Moving on. Home price increases slowed down a bit, but it's already starting to level. For all those who thought we were going to have a big housing meltdown, again, my question's why? What would make you think that? What's going to drive that? I mean, take, for example, the pace of production. Back in 2005, we produced 2.2 million units in this country. That was vastly more than we needed. We had a huge excess supply. Last few years, most of the negativity coming out of my profession, economists, they're mainly whining about how we're not building enough. Or maybe we are, maybe we're not. But I tell you what, look at the number of units for sale for rent. It's at an all-time low level as a percent of the housing stock. There's no excess liquidity out there. There's no problem. Here's another issue. You know, we came out of the Great Recession, and the first thing we saw was, of course, the creation of Dodd-Franks. And that was Liz Warren's baby, to say the least. And there were a few parts of Dodd-Franks that I actually agree with, but there was a lot that was bad. One of the bad parts was how it put the kibosh on mortgage lending. I'm always amazed how political leaders seem to move against the best interests of their base, whether it's Trump desperately trying to dismantle Obamacare or Liz Warren putting the kibosh on mortgage lending. They're hurting the people who support them. But it doesn't seem to matter in this political environment. Now, that had an impact. Look at home ownership rates. It literally fell all the way through 2015, 2016, and has just now started to rise again. That's because it's hard to get a mortgage. But here's the silver lining. Look at mortgage origination by credit score. Over the last decade, the median credit score has been above 750. So households don't have a lot of debt. They look like they're spending money on all sorts of fun stuff. The mortgage market looks incredibly clean. There isn't an excess supply. Why would we have a housing meltdown? It's just a nonsensical comment to make, but that's what you're being fed on a day-to-day, minute-by-minute basis coming out of this ridiculous press stream we're being fed. There's no problem in housing, but housing costs are too high. Anybody been watching the Democratic debates? I don't recommend it. It gives me a nosebleed. I don't know about the rest of you, okay? It hurts, really. By the end, I'm just like gushing, my head's pounding. And it's amazing. Well, housing is way too unaffordable. Really? This is a share of renters by housing costs as a percent of household income, share of homeowners by housing costs as a percent of income. These are people with mortgages. The orange line are people who are non-housing cost constrained, less than 20% of income spent on it. And the blue line are people who are housing cost constrained. By the way, this line's going down and this line's going up. There's no housing cost problems in the United States. What are you talking about? Well, don't let Bernie Sanders hear that, because he's got a plan anyway, okay? Millions of new units with a $2.5 trillion funded wealth tax. Housing for all, he claims. Really? I mean, politics has devolved into what polls well. It does not matter what's right or wrong, what's realistic or not realistic. All that matters is, how does my one-liner poll? That's kind of a scary place, to say the least. Now, what caused the housing market to slow and then pick up speed again? Mortgage rates. Last year, we hit 5%. Ooh la la, 5%. I'm a Gen Xer. Who's a Gen Xer? Anybody? All right. If you're a Gen Xer, you had the privilege of listening to your father tell you 14 times a month about the 57% mortgage rate he paid back in 1982, okay? Or was it 47%? I don't remember what it was. It got bigger every single year. That's all I know. But it was really high. You know, come on, give me a break. Well, yeah, 5% wasn't all that high. And by the way, with the bond market rally that basically came after the big stock market dump, interest rates are now below 3.5%. Third quarter of the year, an enormous explosion in demand for mortgages. Watch out, 2020 is going to be a very good year for real estate as long as you own. If you don't, it's going to get real expensive real quick. Now, what's funding all this? Strong labor markets. Again, month to month, forget those month-to-month numbers. It's a survey, it's noisy, whatever. Year over year, we've been adding basically 2.2 million jobs annually since 2012. Nice, steady labor markets. 3.7% unemployment rate in the U.S. right now. 3.7%. It's about the lowest it's been in 50 years. The job openings rate, 4.6%. We have more job openings than people looking for work in the U.S. economy. Yet, nevertheless, how many politicians have to get on stage and immediately start talking about jobs, 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 jobs? We need jobs. No, we don't. We need workers. We have lots of jobs. Can you stop talking about jobs for just a second? They're irrelevant in this particular economy. And by the way, the tight labor markets have a very good effect. Wages are going up. What? Not true. Can't be true. Of course it's true. The monthly number from the BLS is garbage. Anybody who understands the current population survey understands the problems there. We have a solution. The good folks at the Atlanta Fed do something called the wage tracker. And when you take their numbers, turns out over the last 6 years or so, average wage growth has been about 3.8%. Real. terms. Great. Median wage growth running about 1.9%. These are fantastic numbers. The mystery isn't why wages aren't rising, because they are. The mystery is why our labor force isn't growing faster. With lots of job openings, wages going up, why aren't people pouring into the labor force? Well, the answer is they don't exist. We have a problem. You see, you boomers, you were all raised in families of 15 kids. On any particular day, your parents had a 14% probability of remembering your name. You were so traumatized by this, you all had 1.1 kids, which you excessively overparented. And you know, the millennials that work for me are giving me a nightmare because I'm constantly on the phone with their parents explaining to them why they didn't get a raise this year. So I want to let you know, I go home on a weekly basis and beat my children because I don't want to be millennials. That's not true. Maybe a little. Point here, of course, is the issue we have is that 1.1 kids, millennials we're told over and over again, they are the biggest generation ever. They're 4% bigger than the boomers, and the boomers are retiring. And now, every time a boomer retires, there's only 1.04 millennials reluctantly moving into the labor force. But of course, it's going to get worse because over the next decade, 22 million more Americans, 18 million are going to be 65 plus. In the next 30 years, 60 million more Americans, 35 to 36 million are going to be 65 plus. We have a problem. It's a demographic issue, and we need bodies. It's as simple as that. Now, mind you, there's another implication, and that, of course, is for the fiscal deficit. You know, we were already anticipating an explosion of fiscal debt, and Trump said, you know what? I'd say we get ahead of the curve on that, and let's make that a problem right now. And he's done a hell of a job, right? Almost $1 trillion of borrowing this year, and it's only going to get worse. So the Democrats take over, and the first thing they say is, hey, let's make it even worse. Let's expand Social Security benefits, because that's what they're talking about. Really? Why? Look at the net worth by age group in the U.S. economy right now. This generation of retirees is the richest ever. Richest by far and away ever than any preceding generation. Millennials are falling behind. The retirees are richer than ever before. And you know what? Let's give them more. It's just nuts. It's so out of touch with reality. And it goes this. I've showed you this for the last 2 years, and I keep showing it because it just shows you how crazy D.C. is. 2 years ago, the Congressional Budget Office, a great group of economists who God knows how they live on a day-to-day basis in that environment, they continue to just put out good data and good research, and they said, hey, let's make the economy grow faster. How do you do it? Number one, enact immigration reform to increase the number of workers. Incredibly obvious and exactly the opposite of what the president wants to do. How about reforming the income tax code? Now, reform is a very specific word. We've had a couple episodes of reform. Kennedy had a huge tax reform. Reagan had a huge tax reform. Tax reform means bringing down top rates and getting rid of loopholes. It's evening the tax base. We didn't have that, folks. They got rid of the top rates. No one got rid of any loopholes. And as a... What? Salt?
State and local income tax.
Oh, that's whatever. Yeah, well, those are terrible things in the first place. Actually, cheers to the Republicans for getting rid of some of that. So, but they didn't do it nearly enough. And by the way, they went after salt. I agree with you on that one. There's no doubt about it. But they didn't get rid of the big ones, right? Like, for example, the carried interest deduction and all that kind of stuff. The stuff that's really problematic. In fact, 2018 numbers came down, and for the first time, people making over $500,000 a year paid less in taxes than people making $100,000 a year. So that's how extreme the situation has gotten. So we haven't actually fixed anything, any stretch of the imagination. Number three, increase the Social Security retirement age Yeah, it's not going to happen. Quite the opposite. They'll expand those benefits and reduce deficits by $4 trillion. Well, finally, we have a bipartisan agreement. No, we're going to increase deficits by $4 trillion over the next 10 years. It's nice to see the Democrats and Republicans working together, isn't it? You know? It's nice that they can agree on something. The top 4 things they're doing the exact opposite. And it's like, wow. What kind of world do we live in? It's crazy. It's crazy. What about this manufacturing recession? We've all heard about that, right? Actually, it's terrible. You heard the ISM indice drop below like 46 or something. That was a terrible number. What is the ISM indice? You're like, what are you talking about? Oh, you mean that thing that everybody's going on and on about. It's a confidence indicator, people. It's not a real number. Let's take a look at the industrial production statistics, which is based on reality. How does that look? Well, on a year-on-year basis, industrial production is down about 0.2%. Okay, that doesn't look very good. After all, if you go back to 2015, industrial production was declining by about 1.8%. And you all remember how bad the recession in 2015 was, right? You remember? You don't remember? Oh, yeah. Turns out it didn't mean anything. That's what I mean. Again, what? What? I like it. I got an echo in here. But of course, why is it happening? We've all heard. It's because of the trade war with China. Trade war with China, terrible. Every single week I hear another story about the trade war with China and how terrible it is for American consumers. We are getting crushed. Now, out of curiosity, what I love is watching a reporter desperately trying to find the tiniest bit of evidence that the Chinese trade war has meant anything for the American consumer. The other day, honest to God, I was watching some news thing, and they were running around, and they found a small business, who's been terribly impacted by the Chinese trade war, because they get one of their primary sources of supply from China. And this person had raised prices on their products by 15% because of tariffs on China. You want to know who they were talking to? A tattoo parlor. Turns out tattoo ink comes from China. Who knew? So there's some millennial out there who may have to pay 15% more for that cool tat in their arm next week. I'm feeling terrible for them. Come on, people. This is tough. But really, it's funny. We hear all the time about the Chinese trade war. Does anybody in this room, can any of you actually point to anything in your life that has been altered by these 25% tariffs? I'm sorry, what? Scotch? Are you drinking Chinese scotch? Sir, you have a lot more worries than tariffs. Let me tell you right now. You do not want to drink Chinese scotch. You remember that ink, the tattoo ink we were talking about? Same barrel. Look, I don't agree with most of anything that Trump does, but I agree with him with slapping these tariffs on China. 20 years ago, they signed a WTO, and every year since, they go out of their way to violate every part of it. And they do so brazenly and openly. They're just in your face about it. And you know, we've been letting them get away with it because it's like corporate America just thinks that China, you have to be in China. You have to get along with China. They're the next big, forget that. You know, I'm amazed. Apple Computers is so desperate to be in China that they're willing to hand away all their trade secrets to Huawei. What the hell's wrong with you? Stop being so short term. Think long term. This isn't going to work. And so Obama should have said enough is enough. Bush should have said it. They didn't. Trump, even if for all the wrong reasons, he stood up and he said enough is enough. And he put the kibosh on these guys. And what's interesting about that is what's happened. Nothing. Nothing has happened to us. Largely because we put a 25% tariff and the yuan depreciated by 15%. They've already picked up 15% of the tab. Why? For an obvious reason. 0.75% of our economy goes there annually. 4% of their economy comes here. They're far more exposed to any kind of problems in terms of trade wars between our two countries. Of course they are. Not us. And it's not just the declining yuan. I got a buddy of mine who makes apparel. One of his big clients is Target. And think of Target, think of Walmart. How many suppliers do you think a Target or a Walmart has in China? Oh, thousands is the answer. You know, if you're a Target and you look at your Chinese suppliers and go, yeah, well, when we have this little tariff issue, so you know what, I'm giving you all a 10% haircut. Do you know what the Chinese suppliers say? Thank you, sir, may I have another? They don't have an option. They don't. We have market power, we have a strong dollar, we don't care. It's irrelevant to us. And oh, by the way, for all the trade war conversation, this is real exports and real imports. All the way through the second quarter. I looked at the third quarter number, both of these are up, not down. Does anybody see any problems in trade? None. Yes, we're exporting less to China. Yes, we're importing less from China. We're buying more from other countries. We're selling more to other countries. It's completely irrelevant to us. And yet every single day, we're told how terrible it is. It's so out of touch with anything resembling reality. We're getting worse. We don't seem to have any ability to actually look at a number before we have an opinion. It's crazy. You know what I am worried about? NAFTA. Because, you know, we had NAFTA 2.0, which is functionally NAFTA 1.0. Thank you. Let's just get over this. Canada, Mexico, far more important trading partners. And yet this is stalled. Why? Because the Democrats took over Congress. Suddenly it stopped. Why? They want their handprint on it. This should worry you way more than anything what China does. These are important trading partners with us. Yet this is not going anywhere. This could be scary. Pay attention to this. Next time someone calls you or talks to you about China, say, forget the China stuff. Pay attention to what's real. How about commercial real estate? Well, again, things are fine. Overall transaction volumes, nice and steady. This is the origins of capital in the United States. Everybody's heard how there's a giant pullback in capital out of China, right? We've all that Chinese aren't investing anymore. Yet overall foreign investment actually has been on par. There's been a massive expansion, huge. There is billions and billions of dollars of U.S. investment coming in from Canada. Now listen, I love Canada, okay? But there's 30 million people there, eh? Where's all this money coming from, eh? Perhaps Vancouver, as they say, eh? Never count a good Chinese investor out. He'll figure a way to get his money here, okay? There's no money leaving. Give me a break. And in terms of commercial itself, you know, overall investment's been really, really subdued this time around. Overall commercial investment in office buildings, investment in retail is below now where it was in 2006 in real terms. It's not been an aggressive cycle. Now, things have evened off a bit. You know, look at national office vacancies, it drifted up a bit. But I don't get too worried about this. In fact, in general, this is an interesting graph for all these of you in commercial real estate. This is change in vacancy rates for a bunch of cities in the West, and this is change in rents. And the places that have declining vacancies don't have high rents. It's actually the places that have zero change in vacancies that have high rental growth. Why is this? It's demand-driven, not supply-driven. In this kind of economy, where near full employment and everything else, it's about the newest building to get the best employers. It's all about demand-driven sort of stuff. That's what's happening in places like San Jose and San Francisco. The new buildings are getting the money because they're new. It's as simple as that. But more important than that, you look at retail, vacancy rates are drifting up a little bit, warehouse drifting up a little bit. The important thing here is as a result of this, there's actually been a slowdown in overall completions. That's why one of the reasons why you see, say, investment in structure slowing down this year. They're responding to basic fundamentals. We have enough supply, time to pull back. This makes me feel good, not bad. The market's responding the way it should. Overall, bank lending is growing a little bit. Things look a little bit better. Multifamily's picking up. The development's still a little bit weak. Farmland's picking up for all the farmers out there. C&I loans are doing okay again. Look at overall numbers, demand for loans are picking up, and delinquencies at commercial banks are incredibly low. Commercial mortgages in the banking system are at an all-time low level of delinquencies. Again, good solid numbers. But despite all this good stuff, of course, the Federal Reserve is feeling a little bit pinched. Pinched in part because everybody in the world is starting to cut interest rates yet again. We're in a big one of these rounds. Now, it's worth talking a little bit about the Federal Reserve, for better or for worse, as the case may be. Because again, kind of like the stock market, We're told all the time about how powerful the Federal Reserve is, right? And the deification of the Federal Reserve, to me, gets a little bit, shall we, over the top. And I know, we got people in the banking sector here like, oh, don't go here. Don't pop our bubble, okay? But this is a craziness. This is a Wells Fargo economy. By the way, if you want good data, go to the Wells Fargo economic analysis site. They have a lot of good data. But do yourself a favor. Don't read any of the words, okay? The words are a problem. Data, amazing. Words, not so good. And this is a classic case, right? Start of the year. Lower mortgage rates have firmed up housing activity. That's true. Lower mortgage rates have firmed up housing activity. So the Fed's policy pivot and the resulting turnaround in financial conditions are primarily responsible for this. So let's get this straight, Wells. The Fed did a policy pivot, and then the bond market responded favorably, and now we have low interest rates. Sounds good, except for that is not what happened in any way, shape, or form. What happened was the stock market sold off, the bond market rallied, 10-year bond rates dropped. Oh my God, the Federal Reserve found they had tightened too much. We had a flat yield curve, and they had to do a policy pivot. The bond market forced the Fed to turn. The Fed didn't cause the bond market to turn. Why are you saying stuff like that? It's ridiculous. But of course, they've been cutting. We had our third cut this morning, third in the row. By the way, not enough for the president, okay? We need more. He wants 0%. I want a negative 10% federal funds rate tomorrow. Now, the real question for me isn't why they're cutting. They're cutting for obvious reasons because they tighten too much. The real question is, why do they tighten too much? Now, the answer, of course, they were worried about inflation, but there was no risk of inflation. I've talked to you about this before. Inflation last year hit 2%. That's target, okay? That's when you send the Federal Reserve flowers and a box of chocolates, and you go, congratulations, you hit target. You don't panic, you don't freak out, you don't start tightening. And by the way, inflation since then has gone back down to 1.5%. Look at money supply growth. It's running 4% year over year. This is incredibly tight. Did anyone remember a couple weeks ago when the Federal Reserve had to inject billions of dollars into the overnight markets? That's because money supply is too damn tight. I don't get this. Oh, I do. The guy running the Federal Reserve is a lawyer, okay? Now, I love lawyers. Don't get me wrong, folks. I know there's a few of you here. I love you, truly, I do. But I don't want you operating on me. I don't want you fixing my plumbing. I want you doing lawyerly things. And by the way, I'm an economist. You don't want me doing your plumbing either, trust me. So economists should do economist things, like running the money supply. He just tightened because he said, I have to. And now we don't have enough money supply. There's another problem here, by the way, because of the fact that the 10-year bond market rallied, long-run rates dropped below short-run rates, and lo and behold, ba-boom, the inverted yield curve. Now, we need to talk a little bit about the inverted yield curve. Why? Because it's a leading indicator. If you didn't read the news, you would have heard over and over and over and over again that the inverted yield curve has preceded the last 9 recessions. What a powerful leading indicator. Best one we have. So I have a few philosophical questions for you. Things that keep me up at night. Things that I think about. Things like, for example, does free will truly exist? We live in a Newtonian universe, right? Things have steady state paths. Do we really have free will? Or is it about quantum mechanics and the uncertainty, the fuzzy, the whole uncertainty theory? Does that give us free will? I don't know. That's complicated. That's deep. Here's another one. Why is there a D in fridge but not refrigerator? It doesn't make any sense. Why? I don't get it. Why is Gavin Newsom's hair always perfect and Boris Johnson's is never perfect? It doesn't make any sense. But of course, last but not least, if the Fed inverts the yield curve and the economy is otherwise fine, will it cause a recession? Actually, I have the answer, no! It will not. Look, We had a great recession in 2008-9 because we were overborrowing, overspending, and overbuilding. We had an inverted yield curve in 06 because the Federal Reserve woke up to the fact that, guess what? We were overborrowing, overbuilding, and overspending, okay? In other words, the inverted yield curve is like skid marks in the road before the nasty accident. It's a sign of the Federal Reserve trying to prevent a recession, and by the way, failing. That tells us two things. The Federal Reserve has nowhere near the power we pretend, and also tells us something else. An inverted yield curve doesn't mean we're going to have a recession if there's nothing in the road to run into. There's nothing in the road, folks. Doesn't matter. It's irrelevant. Ignore it. Now, what about locally? This is kind of fun. What is your state worse at? There's a lot of big ones here, boy. I like the Midwest. You got the ugliest residents in North Dakota and rape in South Dakota. Poorest health, female criminals, antisocial, cocaine use. I would all stay away from Washington, just saying. But putting all this to one side, a little more reasonable graph. And you know, we've talked about that. I think I showed this to you last year, and it's an important question. This is unemployment rates on a state by. I'm going to let you ponder that graph on your own time, okay? Because I know Mark's ready. Mark's got that look on his face like, oh God, here we go. Unemployment rate on a state-by-state basis, light or darker colors. What is a darker color? A higher or lower unemployment rate? Higher. Exactly right. Lowest unemployment rates are in the Midwest. Yes, they are in Minnesota, North Dakota, South Dakota, Nebraska, Arkansas, and of course, let's not forget Kansas. Does anybody want to know why? Has anybody been to any of these states? Okay? It's too hot, too cold, and you're running away from a tornado constantly, okay? People don't want to live there. But this is important because you got to remember, we live in labor-constrained times. Unemployment rates don't tell you what's a healthy economy. Quite the opposite. They tell you where people are moving. People are moving away from the Midwest. That's why you have low unemployment rates. Where are they moving? Oregon, Idaho, Nevada, Arizona, South Carolina, Tennessee, North Carolina, Florida. The places they move are the places that can grow. So population movement is who grows right now. And of course, look at California with its negative numbers. Here's another way of looking at it, because it's kind of intriguing. This is payroll job growth versus labor force. More labor force, more payroll growth. Simple as that. Very simple. California is weird. We're the 9th fastest state from a job growth perspective over the last 5 years, and yet by far and away at the top 12, actually the top 20, we have the weakest pace of labor force growth. It's a very strange place that our state of California has found ourselves in. And we are doing great. We're growing faster than Texas, 2.4%, 1.9% over last year. GDP growth growing substantially faster than the U.S. overall. These are good numbers. These are really good numbers. Who's growing fastest? Well, San Francisco, San Jose, top of the list. Now, mind you, this isn't because the coasts are great and the inland regions are not doing well. Quite the opposite. The third fastest growing since the Great Recession is the Inland Empire. You look over the last 5 years, who's growing the fastest? San Francisco, San Jose, and you guys are clustered in with the Inland Empire, Fresno, and Sacramento. Yeah, that Fresno. Which yet again goes back to the idea that what drives growth? Labor force. Simple as that. It's not about economic health. It's about bodies, about people. In fact, if you look over the last 25 years, coastal Southern California, basically where I'm from, LA, San Diego, Orange County, slowest growing part of the state. Inland Southern California, 81% growth in 25 years. Inland Northern California, 52%. The Bay Area, 40%. A couple of years ago, I showed you this chart. They were the weakest. But the Bay Area has changed its tune. It all, of course, has to do with labor force growth. Now, San Jose is doing great. 2018, 2019, actually better than last year, 3.1% growth. Great numbers. Information, of course, that's information technology. 8%, government's up. Professional, 4.7, admin support, manufacturing, financial activities. Great numbers, but logistics, construction, management, hospitality, retail, trade, the kind of sectors that hire lower paid, lower skilled workers, they're having a tough time. And again, it gets to the idea. What's the biggest problem here? Well, the sectors that are growing are bringing people in, but these sectors, of course, can't compete for expensive housing. Tech's doing fantastic, better than last year. I remember 2 years ago, everybody was worried about a tech meltdown. I said, not going to happen. Last year, I said, it's already starting to come back. The numbers are fantastic. Tech is booming. 2 good years of venture capital. Here's some of your biggest venture capital investors here in the region. Good, solid numbers. Fewer deals overall, but numbers on par. What you have going on right now is venture capital is going after bigger boys in the space, which, by the way, is probably not a bad thing. You know, there's a little bit more stability there, as the case may be. Tech overall is doing fantastic. Businesses are still investing tons in information technology, despite the fact that there's a slowdown in overall business investment. Yeah, they're not building office buildings, they're not buying tractors, but they're still buying computers. Still doing really well on that particular front. Overall commercial permits in San Jose actually going up, but you start to see some of the constraints when you start looking at Bay Area vacancy rates. What's interesting here is how vacancy rates, with the exception of, say, San Francisco office, for the most part, vacancy rates are actually drifting up. So you have more and more investment in non-residential real estate, but vacancy rates are not falling. In fact, in some cases, they're actually relatively high. And this gets back to a broader point. You know, a few years ago, we were growing at 3% in the state of California. We're now down to 1.5%. And that's because we're not seeing labor force growth. And you can see it in the unemployment rate. Unemployment rate in California is the lowest it's ever been. By the way, take a look at this. This is the current unemployment rate in all these MSAs in the state, and the lowest it was before 1990 to 2015. Modesto, Yuba, Redding, Chico, Inland Empire, Stockton, Ventura, California, Merced, Salinas, Los Angeles, Vallejo, Hanford, Sacramento, San Francisco, Fresno, Oakland, San Jose. Every one of these economies has record low unemployment right now. So it's not just the coast. The entire state is not having enough labor force growth. And that, of course, is driven by a lack of housing. If you wanted 2% job growth in California, you need 200 to 250,000 permits per year. We're building 120, 125,000. And that doesn't even include the 2 million backlog. But we hear all the time it's an affordable housing crisis. It's not an affordable housing crisis. It's a housing supply crisis. Take a look at the numbers. Housing units per capita, lowest, second lowest in the nation. Vacancy rates, second lowest in the nation. Overcrowded housing, highest in the nation. Overall, multiple generations living together, highest in the nation. We have a supply problem. We started the year out great. This governor had all sorts of plans. He was going to have SB 50. He was going to cut state funding for cities that don't have enough housing. We have a YIMBY running the state housing committee. What do we get? Rent control. Now, mind you, it's not pernicious rent control. You still get to raise the rates when it flips. It's still 5% plus CPI. It's relatively benign, but it's the wrong thing. Look, you can't fix this by attacking affordability. If you help affordability, you hurt supply, which hurts affordability. You got to tax supply. And you know what? With the overall housing market slowdown, permits have slowed down. You look here in the region, unemployment rate's incredibly low. East Bay, which has been the historic home of housing of workers for the West Bay, it's below 3%. San Jose, San Francisco, below 3%. Now, mind you, San Jose and San Francisco have done much better in this cycle. And they have because, guess what? They've had labor force growth. And they have because San Jose and San Francisco built more housing over the last decade than they did over the previous 20 years. Great numbers, great numbers. Now, I know median prices peaked and they softened just a little bit, but they're going to start rising again. And you know, here, affordable housing crises, rents have gone up, vacancy rates are relatively level, but incomes are rising faster, and median rents per household income falling in the Bay Area. It's not an affordable housing crisis. It's a housing supply crisis. Build more, build more, build more. You don't have to. You don't have to, but understand the consequences. Understand, Mark, sit first. Just a few minutes. Sit. You're making me nervous. I'm almost done. Sit. 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 Oh, let's go back to China. Look, if you don't want to build housing, don't build housing. But don't complain when every highway is bogged down by people making 2-hour commutes every day. Don't complain when your kids can't afford to live down the street from you. Don't complain when the county starts suffering because you can't expand enough jobs to actually pay off these damn pensions we promised our public workers. There are consequences to these choices, and there are ways of expanding housing in relatively benign ways. Not to get off topic and expand this too long, but I will tell you, like a year ago, I was at one of these presentations, and I had someone in San Mateo stand up and say to me, "But you don't seem to understand. San Mateo is completely built out. We have no room for housing." To which I said, "Lady, if you go Hong Kong, you can get the entire population of California in San Mateo County. So sit down and shut up." But more specifically, permits are down. They're going to pick up again, but folks, you need housing, because if you don't have housing, you can't build the support economies who do support your tech sectors. And that is a problem. We need housing, as simple as that. So, to Mark's happiness, we are wrapping it up. I'm not even going to go through this. It's fine. The economy's fine. Another year, bigger profits. Another year, Mark's going to make record money. Next year, I expect nothing but Opus One and cake bread across that wine list. Enough of this stuff. Bring us the good stuff, baby. But remember, it's not jobs, it's workers. It's not who pays, it's what are we paying for. It's not levels, it's structure. It's not income inequality, it's wealth inequality. It's not funded, it's unfunded. It's not business investment, it's public investment. It's not inflation, it's slow bank lending. It's not the cost of housing, it's the supply of housing. We're still not asking the right questions, folks. We're still not asking the right questions. You got to get out there and tell people. Times are good, but we have to be big boys and girls and stand up and talk about the real problems in real ways. Time to put the political nonsense to one side. Time to run policy off to something more than what sound bites poll well. So, have a great year. I look forward to the cake bread and Opus One next year. Thank you very much. Thank you.